would send my wife takeout dinner as thanks for having me home late.
I believe I promised a Subway sandwich, and I couldn't find one close enough to your house, but
I'm
we'll,
upgrading you because that was far too cheap.
don't worry, don't worry. We'll take care. So, Stephen, hey, for people who don't know you here, before we get started, your background. I know you've got a lot of background in finance, so take us through it real quick.
So yeah, I'm the CEO of GoldCore, and we're 20 years old this year. Prior to that, I worked in Wall Street for Bankers Trust and also then Goldman Sachs. And when I was in Goldman Sachs, I was part of a team in the equity derivatives division, and we specialize in program trading, which is kind of large basket trading of stocks internationally and also domestic US. Our clients would have been the large pension funds, primarily in the States and in Europe as well. So I learned an awful lot about risk. I learned an awful lot about trading, sales, the financial markets in general, and then I brought a lot of those lessons back to Goldcore when I joined there in 2004, and then we grew the company from Dublin to kind of an international specialist in the precious metals markets now.
Yeah. So, hey, real quick before we dive in, how is I see gold and silver up really strong right at this moment. How are the trading volumes today? Are people diving in?
Yeah, out the door. Out the door. It's very very busy. We have an awful lot of people opening up accounts. A lot of people are looking at gold afresh. The price breakout is very very bullish. It's been in kind of a bullish pattern now for some months, and it's been waiting. We've been waiting for a breakout. We figured it would pull back, and it did. But this news has really kind of underpinned the systemic risk credentials of gold in a portfolio, and it's really kind of brought it to the fore again. So it's a very, very busy day for us here. The team here are really, really busy.
Yeah. Yeah. Full disclosure for everybody listening, I am a member of GoldCore. I keep precious metals there. Steven's company and Peak Prosperity, we have a relationship. We get people special deals, and I do direct people to Peak Prosperity Tribe members to GoldCore because I really believe in what you guys do and how you do it. So, and it feels good, I got to say, to have what I call the jurisdictional risk spreading, right? So I've got some gold and silver now being stored in various parts of the world because I don't know what's going on anymore. You know, so who knows where I want to be
It's
at some
important.
point in the future.
Yeah, I mean, we have thousands of clients all over the world. They feed in huge amounts of information into us. We kind of share that role of vigilance. We don't know what the future holds, and we always say, listen, you need to have precious metals in your portfolio, but you also need to spread it around in different jurisdictions because you're never going to be perfectly hedged. No one knows the future, but it's a good idea to
Yep.
have that systemic risk hedge in your portfolio, whatever
Yep.
percentage you think is appropriate.
Absolutely. So, in the comments, Arsenal Rain says metals sold out online. I've been hearing this a lot. People have been having trouble getting access to them. And Deuce Durden asks Gold Corp. No, that's Gold Core, CORE. So that's one of the reasons, though, that I like working with you guys because you have access to, like, when various retail shops get sold out, you still seem to have access somehow. So that's good stuff right there. Yeah.
It's amazing. Like we've because we grew up in Europe, in Ireland in particular. We have distribution agreements with a lot of the world's mints and a lot of the refiners in Switzerland and in Europe. And so we can tap liquidity. We can tell you where the liquidity is. We can tap it very very easily, and that's what we do. So we're plugged into the
Yep.
Swiss refiners, and you know the bars, silver bars, gold bars come right off the line there.
Yep.
So yeah.
Yeah. Great. Hey, Ryan, let's go to slides real quick because I want to just look at this now. So this happened on the 9th of March. We saw the Silicon Valley Bank SVB was designated on the 10th. That was Friday, midday. Very unusual, right? Usually they wait till the evening and they tell you Saturday or Sunday that something's gone. So we saw that SVB went down on Friday, but even before then, too, we saw also a bank run on First Republic Bank as well. And that's just a run. Those are just people lining up out there. They've just caught the vibe. So, Stephen, the way I'm interpreting this, by the way, First Republic has not yet gone down, although if we look at their stock price change today, minus 65%, clearly there's some trouble here. So these people were reading the tea leaves right. When it comes to this kind of stuff, I advise everybody I am a shoot first, ask questions later kind of guy. If I see the stock price of my brokerage, my bank take a huge tank, I just pull my funds and I leave, and then later I figure out what's going on. Is that to me? This looks like people have rightly potentially lost faith in the system. That's low faith right there. That's what I see. What do you see?
Yeah, and we've seen this time and time before. The system, I suppose, in normal trading environments, the system can work really, really well. But when you stress it and you take interest rates from, essentially below zero, and you then move them up at such a pace, suddenly you find out who's swimming naked as the tide goes out, as Buffett said.
Yeah.
And I think what we're seeing right now is an awful lot of balance sheets being exposed because they have a lot of unrealized losses on their books where they've been parking depositors' funds. And you have to realize as a depositor, you don't actually have your money in the bank. You've lent the money to the bank, and the bank has lent the money on somewhere else or has placed the money in some other instrument. And then there's a transmission of risk. And the risk transmits right across to the depositor, but the benefits don't always transmit across, so the bank wins. And so what we have here is interest rates have gone up, bonds have fallen, and what I find really, really fascinating about this time versus 2008 is that it's not so much the banks were investing in super high risk debentures and loans. They were invested in U.S. Treasuries, the most what's known as risk-free investments, and these investments have fallen in value and have contributed massive losses on an unrealized basis, which means that they haven't actually sold out of these securities. They're being priced to the market price today, and that price says that they've taken huge losses. And in many cases, these banks have a buffer. It's called a Tier 1 buffer, and they have their own capital. And in the case of Silicon Valley, I understand that they had about 15 billion in losses, and they had about 16 billion in capital. So they got wiped out. So the market is now looking around and saying, well, who else has been on this, has been doing this and investing their deposits in with the US Treasury, and who are sitting on losses? And the answer is quite a lot of banks are. So the federal authorities are looking to shore up this process and hopefully inject some sort of security into the market by backing up Silicon Valley. But the question is, do they have the firepower to bail out the rest of the system? And the FDIC, I understand, has issued information to the effect that there's about 650 billion in unrealized losses inside the system, which is an extraordinary amount of money. And so the question is, what will happen to those losses? Are they going to be backed up by the US government? They've said that the US taxpayer is not going to pay for this, that they're going to be paid for, these losses are going to be covered by a levy of some description, in the case of Silicon Valley and another bank. But there's a much bigger problem here, and the answers aren't apparent as to what the actual strategy is going to be. So, as you say, there's a lot of questions. People are shooting first and asking questions later, and you can't blame them, I think.
No, you can't. So for people listening, the balance sheet of any entity is a very old established thing. And let me see if I remember this right. It's assets minus liabilities equals shareholder equity. So that equity part, is that right? Yeah.
Pretty much, yeah. And you have different maturities on those assets and liabilities.
Yeah, so that equity part, is that cash that they have? So when you say the equity gets wiped out, that piece that remains down there, often that's a non-cash position, right? That's the so-called equity in the company, but in terms of what they need from a cash management standpoint, then you have to wander over to the cash flow statement and see where they're actually at. So I think Silicon Valley got caught out. They had equity, but they couldn't raise any cash.
Yeah. I mean, my understanding is that they're actually quite a prudently run organization. They weren't lending recklessly to the marketplace. They had quite a lot of assets. In fact, they only lent out about 45% of their deposits were lent out into the market in loans. and the additional deposits were placed in the Treasury market. And then when rates went up, the price of bonds went down. And as a result, they had bought at a level, and then the price had fallen, and that meant that those investments had huge unrealized losses. So those losses have to be paid for first by their own equity, and that's what's really happened here. So they got wiped out, and then the question is, what other banks also have done the same thing? Because remember, a lot of these banks, when after the financial crises, a lot of these banks were told, you know what, you need to have bigger buffers, bigger capital buffers, and you need to invest more wisely. And the thinking is that U.S. Treasuries are the safest place to invest, and those securities have fallen a lot, as does the rest of a lot of other bonds as well. So those losses are real, and they're also hiding in pension funds. They're hiding in insurance companies. They're hiding all over the world. They're hiding in foreign sovereign wealth. So one of the biggest losers in this is, in fact, the Federal Reserve. I think my estimate I've heard there is that they've lost about 330 billion in treasuries, and they only have 45 billion in actual capital. So they're one of the biggest losers in this. Now, they don't trade on the market, but it just shows you the extent of losses that have been incurred right across the system.
I love it because I think the way the Federal Reserve, if I read this right, the way they were categorizing those losses you're talking about, they called them a deferred asset. So it's fun when you're the Fed. You can do whatever you want. I wish I could call my losses a deferred asset.
Yeah, that'd be wonderful, wouldn't it? Yeah.
Yeah, that's because they're pre-deducting those from future remittances. So that is the taxpayer getting it in the shorts on that one, right? Because the Fed, anything beyond beyond what it needs for its operating expenses, plus the 6% special dividend that goes to all the owners of the Fed, which, by the way, isn't taxpayers, it's banks, who are taxpayers, I guess, as corporations. But at any rate, once those are done, the remittances are the remaining balance of all their earnings from all those mortgage-backed securities, treasuries, all that, right? So they've tanked all of that. So that usual $100 billion-ish a year in remittances that go back to the taxpayers, we're not going to see those for years to come now at this rate, it looks like.
Yeah. What I think is, this story has legs, like nothing we've seen in recent years. And my own feeling, we've talked about this before, is that there is a massive change globally in terms of what constitutes the reserve currency of the world. Is it going to be the dollar? And in the last few months, you've seen so many countries now who have quite outwardly said that they're going to pay for their energy and in non-dollar currencies, the yuan, the Chinese, and
Big
even
news.
more incredibly, just today in the last few days, the Chinese brokered a peace deal between the Saudis and the Iranian regime, which is unbelievable news. It puts them right up there, and we know that they want their currency to become a reserve currency. The Saudis are going to be accepting yuan in exchange for oil, and if you read the press release from the Saudis, they're like, we only care about our own interests, and we have interests in the West and the East, and we're always going to operate in those interests. China is our largest trading partner, and you can't blame them. You cannot blame them for this. But it just shows you, if the demand for dollars wanes because it loses its reserve currency status, and the debt load and burden of the U.S. government is so extraordinarily high, and on the consumer, and you have interest rates going up, and you have inflation biting at the heels of the Federal Reserve, and the markets are screaming blue murder, you have a recipe for a serious period of dysfunction in the markets. And I'm being very kind when I say that.
I know it's almost a euphemism at this point. So that thing. So what did China do? Oh, they only got a diplomatic detente between the Shias and the Sunnis, right? It's unbelievable what they just accomplished there. And people, if I could wave, Stephen, a magic wand and have people begin to understand something, it's that. That was, to me, the biggest news of this past week, way bigger than these bankruptcies. Because really what's happening here, China now imports 14 million barrels a day of crude. The United States at its peak only hit maybe 8, maybe 9, and now it went all the way down to 0. But that's going to go back up again. So now the United States and China are going to be in competition for what's going to turn out to be an insufficient level of export crude. I don't care how much crude is made in the world. I care how much is floating on the oceans and going through pipelines to people who need it, right? So China just laid down a stake for that. Now, why would they put so much into Iran? Well, if you look at a map, you find out somewhere between China and all that tasty Middle East crude is this country called Iran. If they're going to put a pipeline in, that Iran's part of the deal. Yep. So if they're doing that, that means they're already thinking long term, and now it begins to make sense what's going on in Taiwan and all that other stuff, because China's super exposed to oil floating across the ocean to this little thing called the Malacca Strait, which is this tiny little geographic little thing that all the tankers have to go through. It's like the Strait of Hormuz, but the Strait of Malacca, it's tiny. Obviously, China could not protect a choke point like that very easily on a naval basis. So I see all these big things happening. And of course, the context of all that is the dollar, the petrodollar, and China at light speed undoing that particular piece of activity. So that's a really important current to keep on all this. So,
oh yeah, and I could just, again, no evidence for this, but imagine, you let this turmoil, this dollar hegemony contraction occur, and you go, okay, and you let it run for a while, and then you go to people who go like, okay, we have this new currency. It's a lot less volatile. It's backed on, on a future trade relationship with the world that's really, really comfortable. And we're also going to back it by a lot of gold. We're also going to put a huge amount of gold in there, and we're going to make it stable, and we're going to store that gold in other places around the world, and make it very, very safe for people. At first, people probably kind of shun it a little bit because it'd be too new. But you can imagine that kind of taking hold over time, and more countries coming on board as a mitigation. Who wants to hold dollars when you have all the evidence in the world that should you fall foul of the U.S. administration, there's every chance that these institutions will move against you and freeze your reserves. And as a finance minister, you can't take that risk. I mean, and that's not crazy. That's a reality. And I think the argument is very strong now. So next few years, I think, are very, very interesting. I don't know what the U.S. response is, but I wonder from China's perspective, from a geopolitical, if you have your eyes on Taiwan, and the only reason you haven't gone is because militarily, you can't really see what's going to happen. You can't win that collision because the U.S. is still powerful. But if the U.S. has a huge contracting domestic economic problem and an economy, the argument to send U.S. troops halfway around the world to Taiwan to protect a little island doesn't really win. And you can imagine the political support will not be there for that domestic problems will trump anything international. And I think that's probably the strategy that's being pursued.
Well, I need to bring this back around to these bank failures real quick because it's a big fractal mess. Okay, so one of the ways you get through a rough period is you have good leadership, right? Say what you will, but China's diplomatic coups of late have been impressive. And so not as impressive on the United States front, but can I just show you what sort of takes the wind out of my hopeful sails? It's stuff like this. Let's see, where do I start? Probably with this. So finding out that the CEO of Silicon Valley Bank was on the San Francisco Fed's board, and then they yanked him off. They yanked him off right away. But sure enough, if you go to the Wayback Machine, okay, so he's in there. So that means the San Francisco Bank board either was clueless or they knew about this and they weren't really caring that they had very poor risk management practices going on there, right? So that was part one. Part two is when I look at, say, where can I put this? Oh, yeah, here we go. So we also saw somebody ask earlier, Signature Bank also went down. Signature Bank goes down, and then we find out that who's on the board, who's a director of the Signature Bank, but Barney Frank, he of the Frank-Dodd Act, right? Barney Frank. So this is a guy who's writing the literal banking rules that led to this bank going belly up. That's just total clown world action for me. And so here he is, right? He earned $1 million hanging out here on the Signature Bank board, and it failed, and now the FDIC has to cover all the depositors, and so that gives me less. This is just clown world kind of stuff. Yeah, and then what else did I find out? Let me see if I put it in here. I don't know if I did. So it turns out HSBC is going to buy SVB's assets for £1, and it also turns out that on
the UK bank.
Yeah, right. The bank that got caught pushing the cash through the specially fitted Mexican, teller windows, right? That HSBC, right? I mean, they've been fined and caught with so many things. So those folks, right? And you know who sits on their board? Comey, the former FBI official, right?
Oh, wow.
Comes out of the FBI. Obviously, once you're head of FBI, your next logical step is to serve on a bank board. Makes sense, right? Because the FBI is just known for its amazing ability to churn out business leaders. So when I'm looking at this, Stephen, I just see it just feels like a nest of corruption. Here's the bottom line with corruption. Businesses, small businesses, consumers, taxpayers all get hurt. The corrupt people seem to do fine and pad their nests and carry on, and nothing ever happens. So that's how I interpret when I showed that picture, Stephen, of all those people lining up right away. That's to me is a legitimate response to finding out you live in a clown world where it's just unfettered corruption that never goes punished. So,
yeah. I think it's a really interesting point you make. But to me, that at the heart of this, and in the future, please God, we'll learn from these mistakes and these issues. And one of the things I hope we learn, the lessons we learn, is there's only maybe 3 degrees of separation between a lot of the people who move in these circles. So everyone knows someone who knows someone knows the person that they are regulating. And if you have such a tight knit group, how can you possibly do your job as a regulator, as an enforcer, if the people that you're regulating are going to be paying your salary whenever you leave that regulatory job? And it just stands to reason that, just for the sake of humanity, that these enormously important systems of government are held to a much higher level. And I would actually argue, and maybe you don't agree with me here, but those regulators should be paid an awful lot of money, and so much money that they never have an incentive to ever go into private sector. That they have a fantastic career, they're paid for their brain power, for their ability to actually prosecute their brief, and we shouldn't go cheap on those packages that are offered. They should be every bit as attractive as the private sector can offer, because ultimately they come out of low-paying kind of official jobs, and then they get a book signing contract. They go on a tour of speech tour all around the banks, and they pick up millions, and then they get jobs on boards. And ultimately, you're never going to prosecute your brief if that person's going to actually pay you. So that's your ticket, and I think we have to be realistic about this. It's called regulatory capture. It happens in every major industry. It happens in the financial industry. It happens in the pharma industry, the insurance industry, automotive, everywhere.
Yep. No, there's conflicts of interest. As Charlie Munger, the right-hand man of Warren Buffett, said, you show me the incentive, I'll show you the outcome. It's easy. I mean, we're humans. We've known this since Spartan times, right? So we have these incentives that are just really clearly lead to inappropriate behaviors, right? And just to show you, but we do live in, to me, a clown world. So, Stephen, I'm a big fan of data, and I like words to have meaning, right? And if we don't have shared meaning between words, things don't matter anymore. But look at this. Look how lame this is. Biden comes out, says U.S. taxpayers will not be responsible for losses from failed banks. Okay? So he comes out with all of that. And then immediately you got CNBC picking up the torch saying Wall Street, not taxpayers, Wall Street's going to pay for the SVB and signature deposit relief plans. What? No, it's the deposit insurance fund run by the FDIC that's going to make up those losses, right? And so the deposit insurance fund is a tag that goes out and hits every bank. And then what do those banks do? They pass those costs on. So today I learned I'm not a taxpayer. As far as I'm concerned, that's just it's not even super derivative. You don't have to be super subtle. It's like, here's where the money comes from, and that money ultimately comes from me, right? Whether they hide it or say, it's going to first flow from me to the Treasury and then to the bank, or it's going to flow from me to the bank and then back to the banks. It doesn't matter. We all know who's paying for this, right? I mean,
Yeah, if you put a levy on the financial system, it's the customers of the financial system, i.e., everybody, who's going to pay for that. So it is a taxpayers. It's a tax through stealth. It's an indirect tax on transactions. And it's not Wall Street paying for it, guaranteed. It's going to be the average mom and pop out there in higher bills. And again, there are so many examples of monopolistic behavior within the financial industry in the States, where people pay huge amounts of money for everyday transactions like credit cards, which are unbelievably high on any international comparison. So it's very worrisome when I read that. And I can't believe that they even released that statement and thought that it would
I know.
pass muster with the public.
I
I mean,
know.
like, they must think everybody is an idiot. I don't.
They
I
do.
just don't understand how they thought that would be okay.
Well, they do, and so it is sort of got that clown world. Like, listen, if you don't have any, clearly we don't have adults in charge, or if we do, they clearly think we're idiots, right? But they've shown that over and over again in all sorts of different places, right? With their safe and effective, and all their different statements that they were out there throwing around, none of which turned out to be true. And we're supposed to have the memory of a goldfish, right? You can't. Didn't you just last week say this, right? But we even saw this in congressional hearings where Matt Taibbi was exposing the NSA and the government colluding with the FBI, with Twitter to suppress free speech, right? And we had this representative actually ask him twice for his sources, but she said, tell us where you got the information from. He said no. And then a minute later, right, Jim Jordan is saying, I can't believe that you just asked for his sources. And she said, I didn't ask for sources. Like, no, you just asked who gave him the information for his story. That's called a source. Like, we can't have a shared conversation because we can't even agree what the word sources means, right?
Yeah, yeah.
So the
Well, I
idea
mean,
that we're...
I was going to say, if you look back, this rewriting of the rules of communication and language, we have language wars. If you don't like the question, change the rules in terms of how you ask questions, and label people if they ask what you perceive as an inappropriate question. And this is happening across the world. It's a very scary development recently, because when truth dies in the dark, and it's really, really important that people fight for that right to speak and ask questions. And it's okay to be wrong as well and be mistaken. Yep. But I think it's that cancel culture, it drives me crazy. It's really, really, really scary.
Well, I agree. And so here's the conclusion. So people often ask at a time like this, all right, so what do I do about this, right? Are we just going to complain about this? And I'm like, no, here's the point. You want to understand how the world seems to be working. You want to understand the rules of the game, even if it's rigged and broken, so that you can have a chance of not just being a helpless victim to what's going on. I can't do anything about Fed printing. I can't do anything about inept leadership of banks, but I can take my funds and my wealth out of that system. So since 2008, when I first started doing this, I've been recommending to people to get hard assets: gold, silver, land, trees, real estate, oil, gas. And I've been there because at least those are things I understand. And if you get involved in the right relationships, you can have you can understand it. Like, if you can't, here's my rule of investing: if I can't understand it at all, it's not for me. Right? Yeah. So at any rate, I've been recommending.
As Buffett said, simple and understandable. As Buffett said, it has to be simple and understandable to invest in.
Absolutely. So, I mean, everybody listening to this isn't financial advice, but for your own education, everybody, I think, ought to have a core holding of gold and silver, right? And that's in your hot little hands. You can get it, it's somewhere nearby. It's your insurance fund. You got to have that. So here's how here's my approach to investing, Stephen. It's, will this help me sleep better at night? It's kind of like I don't worry about the world that much for myself. I worry about it for a lot of other people. I worry about who's unprepared, not ready for this stuff that's coming. If I could dig through all the FDIC stuff and show you that they have just a 1.2% of actual deposits are insured through their fund. It's not a big number, right? And sure, they'll change rules and just print money if they have to. I have every confidence in that. But that's going to take our purchasing power and destroy it. So what's your experience with inflation in Ireland right now?
So most people in the West don't really understand what inflation is. They haven't
Hmm.
experienced it in their lifetimes. The older generation have memory of it from the 70s and the 80s. And the problem is that the inflation we have today is not demand driven. It's very much monetary. So it's because they have been basically printing money, and they started a policy of printing money back in the global financial crisis, and they started a policy of active management of the economy with interest rates and guiding the economy. And they've also had a policy of involving themselves in the markets directly to create a veneer of normalcy. And so they have the media are very much in lockstep with this as well. So it's a very unhealthy relationship. The government should never be involved in the marketplace, and they shouldn't be setting interest rates, and they certainly shouldn't be printing money, and the media should hold them accountable. These are just basic truths, but all have been changed of late. So what do I think of inflation? I think inflation is probably one of the most dangerous economic conditions you can have. Not so much at the beginning, because actually you look like you're doing okay because your assets are rising in value. You have savings maybe from previous situations, and you're doing okay. You're making some profits if you're in business. Your actual margins have grown, and you can see the margins have grown in the S&P 500 tremendously leading up to this recent issue or situation. So, but it's what happens over the longer term when real wages start to fall, and the average man on the street realizes that his monthly wage does not cover his expenses. And then when they start going to ground and they don't buy that car, they don't go on holiday, they don't buy that handbag or whatever, that smartphone, they suddenly the economy takes a hit, and then you have job losses, and then people go further to ground, and it feeds off itself, and it basically creates demand destruction at an unbelievable level. And then those assets that were rising start to fall, and then the system resets slowly but surely, very very painfully. And in the worst cases, it goes into a depression cycle. Um, and it's very very dangerous, and it can last an awful long time, and it could lead to a lot of political unrest, and some very nasty people get into power, and then they do very nasty things, and they typically blame everybody else but the actual monetary system before it actually people find the truth. So inflation is exceedingly dangerous, and I don't think the officials in Washington or the Fed are this. I don't think they. I don't think that. I think that they understand this. I think economic history is very very obvious on this point. So inflation should be avoided at all costs, but what cost and what is the price that they pay? Interest rates should be an awful lot higher, arguably. And then and you've seen interest rates have moved up only modestly, and you can see that the pressure it's putting on the financial system already. And I think it's just the tip of the iceberg. To be honest, I wonder now next week will the Fed start to change the language and start talking about interest rate reductions, and then will the market go off on a huge buying binge, and then we'll continue on for another cycle. I don't know, but I do suspect that inflation is probably much more dangerous than a few banks going bankrupt and the system resetting. Over the longer term, I think an awful lot of people will be affected by inflation.
Great. So Finbear asks here, said, do you see the Fed's decision related to what you just said there to open the money floodgates as a green light for risk on investments? Looks like it to me. A risk on investment for people out there is we would move, say, out of safety, which would be bonds, and we'd move into risk on assets, which would be stocks typically, but other things as well. So if we look at this, this is today's action. I think this is Wall Street puts out a little crybaby action and the Fed responds. Both stocks and bonds up strong this morning. This may have changed by the time we're talking about this now, but that's a both, right? So this is kind of a, to me, this is the kind of stuff, Stephen, I saw in 2008, 9, et cetera. When the Fed just says they're going to start printing more money, then everything goes up, right? Stocks go up, bonds go up. It's like a, hey, why can't we have one of everything, you know? So is this, how do you interpret
I wouldn't
this?
take too much. Yeah, I think you have to be cautious taking too much signal on in the days around a situation. We need
Mm-hmm.
to see how the cards lie over the next few days and weeks to see what the trend will be. But you can also add gold is up, is up as well. So everything is up, and yeah, people are looking for cash. So it's an interesting one. Yet some bank stocks are tanking as well. So there's a lot of contradictory signals coming out of the market today. You probably have the
It's true.
market. You probably have the Fed proxies also involved in the market, kind of trying to drive that narrative as they want it
Yeah,
to be.
because I woke
It's
up
unbelievable.
I woke up to this on my screen first thing this morning. Look at all these halts of financial stocks and banks. Halts, right?
Yeah,
That was pretty. That was
it,
not.
it,
That was ugly.
it is. And what's really interesting is that the unrealized losses as reported by a lot of these banks have been out there. It's not a new thing. They've been out there for quite some time. The market ignored them and didn't really understand them, and I think that's actually a big part of it. There's an awful lot of market participants who haven't really seen an interest rate rising market environment. They haven't seen it. They don't know it. They don't recognize it. They don't even know what a contraction looks like. They just only know in a bull market. You know, it's a perfect storm if you ask me um, at the moment.
Yep. So, Stephen, quickly, while we have people's attention, if you
Yeah,
come through this link, folks, that's https://peak.fan/goldcore. You come to that page there at GoldCore's site. You see my smiling face there. You just put your name, email, phone number. Somebody will talk with you. Can you tell people just real quickly what GoldCore does? And I think you're special, and I love the idea of segregated gold storage as a concept there. Really important to me.
yeah. So as I say, we're 20 years old now in October, and we specialize in precious metals. We have about $330 million in assets around the world that we manage for clients, and we've been around a long time, and we're very well trusted. And essentially, if you want to have precious metals in your portfolio, you can buy them from us. We'll ship them to you. We'll store them for you. We have a network of vaults around the world. They're all non-bank, and the standard storage product is segregated, allocated, which means you buy a particular gold bar, and it's in a particular location, and it's not mixed up with anybody else's gold bar. And you can also log into the GoldCore platform and see the valuations, and you can buy and sell your assets. But we also allow you to access the vaulting company system independently of GoldCore and put in your account number there, and you actually see your bars and your serial numbers and all your assets held as per their system real time. So you can check what's in Salt Lake City, you can check what's in Zurich, you can check what's in Singapore, and we have and Dublin and London and Frankfurt as well. So you can spread your assets around. Nothing's held in our balance sheet. It's your asset. It's like having your car parked in our car garage. We know where it's been, so we'll buy it off you right away if you want to sell it, and you pay a very, very modest storage charge. And we have a special relationship with Peak Prosperity. If you go on their website, the Peak Prosperity website, you'll see a link there as well. Click on that, and then it's very, very easy. You can sign up in literally 20 minutes, and our customer care is absolutely second to none. We have
Nice.
a 4.9 star out of 5. I think Chris, you can vouch for it as well.
I can.
We're very client focused, and we don't pay commissions to sales staff. It's all about customer service and us doing well as a company with our clients.
Yeah, fantastic. So I'm a big believer in it. And again, remember, I'm a shoot first, ask questions later kind of guy. Can we talk about this real quick? Credit Suisse. So,
Yeah,
so Credit Suisse has been on my radar for probably 6 months. I've been tracking it, telling people, I didn't like their equity position. Their financials look like a wreck to me. I didn't like the client outflows, but mostly something I track is something called a credit default swap. So for those people who don't know what that is, Credit Suisse has bonds that are outstanding. Stephen, let me know if I'm doing a good job of this, but they have bonds that are outstanding, and let's say the bond yields 5%. Well, I could hold that, and I'm getting 5%, which feels good, but I'm nervous about the company, so I can buy insurance on that bond. What's it going to cost me? Well, it's going to cost 446 basis points, 4.46% to insure that. So now that bond actually in the market is not worth a bond that's priced out at 5%. It's worth a lot less, because why would I pay 5% for a bond that I have to pay 446 basis points or 4.46% to protect? So this is a measure of stress in a company. This goes back 20 years. And we have not seen stress this high in this bank before. A, did I do an okay job explaining that? B, what happens, Stephen, if Credit Suisse gives up the ghost like it looks like it might here?
Yeah, it's interesting. I think all of the entire bank sector is being reevaluated right now because the unthinkable has happened. U.S. Treasuries, the risk-free investment, has now an enormous amount of risk, and I don't even know where that lets you where you go with after that because
What do you mean
what
risk?
other country? Sorry.
What do you mean risk? Are you talking about the default risk because of
Yeah, like
the debt
I
ceiling?
don't know what the credit defaults. I don't know what the credit default swap on U.S. Treasuries are as a bond, but the graph probably doesn't look dissimilar to what you're showing there. So the risk of default and the market for those securities has fallen, just as it has probably for Credit Suisse. And what does that leave you? Because years ago that was the risk-free option. So the entire financial system is under huge duress and stress, and the fundamentals that underpinned balance sheet allocations in the past are now called into question. And the pension funds are heavily invested in U.S. Treasuries, and we also have geopolitically China and obviously Russia and other places would love nothing less than to have a U.S. default on the books. So it's interesting. Credit Suisse has had huge problems for an awful long time, as you know. So has other banks as well.
Mm-hmm.
And if the system generally starts to sell off, and they were already close to the edge, it doesn't really spell good fortune for the future for them. So I would say that it's an interesting one to watch. But as a rule is, you spread your money, you diversify. Precious metals are that contingent investment. They come into their own in times of stress and uncertainty, and the world has become a very uncertain place. And I think it will continue to be so for some time.
Well, for me, I hold gold and silver, but sometimes people say it like it's one word, gold and silver. They're two words to me, and I hold them for entirely different reasons, as well as other hard assets. Gold to me is the only financial asset I'm aware of that I can hold that is not also somebody else's liability. It's a really weird option value that exists because of that, because it exists solely as an asset if you hold it in your possession, right?
Yeah,
So
yeah.
that's very odd because even a Federal Reserve note, $100 bill is the Fed's liability, my asset, right? The Treasury bond I hold, my asset, government's liability, right? So on and on and on. So gold has that weird capability of just existing as a monetary asset. And so that's part one. Part two is, Stephen, can you help shed any light? Because I'm a you can tell I'm a student of things. I dig into things deeply. This is weird, but I can find the thing that is most impenetrable to me is trying to figure out how much gold actually is owned by whom in the world. I can't figure it out. It's held more tightly
Yeah.
than nuclear secrets, it seems, right? Like how much is in the LBMA and how much belongs to who and which has been hypothecated and rehypothecated, meaning borrowed and encumbered and reborrowed and re-encumbered down a chain. How much actually exists? How much is in, the GLD trust, literally unencumbered as a sole asset? I can you help shed any light? I have not been able to figure this out.
Well, the reason is because a lot of it happens OTC, over the counter. It's privately traded between different counterparties. It also has a huge geopolitical aspect to it. But the reportable reserves of gold, i.e., the ones traded and held by exchange traded funds and ETCs as well, and the ones that are held by certain central banks are reported. Um, and but those reportable reserves have increased significantly over the last 10 to 15 years. You can see that. Gold Charts R Us is a great service. You can go on there and you can actually get some great statistics.
Mhm.
But in other countries, such as less friendly to the West, such as China, they have been acquiring gold. Through the back door, a lot of people have said, and have been accumulating gold and haven't been reporting all of their reserves. And so they do so for a host of reasons. They want to control the narrative, and they don't want someone else to control the narrative. So my understanding is there's probably more out there than we think. They reckon that the above ground reserves are about 180,000 tons of gold in the world, and that would equate to about 22 meters cubed of gold. So you could put it into the middle of a tennis court. You could put it under the Eiffel Tower. There's a very, very little gold in the world as a physical weight, as a mass, and that's what makes it really, really interesting. It's also incredibly difficult to mine. It takes an awful lot of energy. You have to move literally a mountain and do a huge amount of work just to get a little bit, and that makes it a really interesting form of money. In fact, I would argue that it's the only form of money that we can truly rely on because it's independent of man. As you said, it has no other liabilities, no one else's liability. You buy a house, you need a renter to pay you rent, and the value of the house is dictated by the rental yield you get. You buy a stock, it's cash flow. You buy gold, it costs you money, and yet it's valuable. So it stands in direct contradiction to every other asset class out there. And when you buy it, and I think this is really important, you give your dollars, you get gold, you have a form of money that's independent of everybody and everything, and it's always valuable. And so I call that financial sovereignty. You actually take financial sovereignty, which you do with that as your business. And I think it's a really important thing for investors to get their head around and think about and dwell upon.
Yeah, I'm big this year as I'm putting a lot more back into helping people achieve financial freedom, which has a number of components to it. But financial freedom to me is when your financial assets that you've accumulated are safe and are creating passive income sufficient to meet your basic needs, right? Whatever, and everybody has different levels of basic needs. So that's an individual conversation. There is no magic number, but to have that sovereignty as part of that is really important, particularly in a world where I don't know where the risks are anymore. I don't like that. I mean, I remember. So I went down this huge rabbit hole, Stephen. I was trying to figure out what's really going on with derivatives. You know, we hear there's quadrillions of them, and what are they? And it's an arcane world. They're basically legal contracts, I discovered. They're not a thing. They're a big ass piece of paper that, a binder of paper that lawyers have sort of hashed through, and they interlink with each other, and they're very complicated. Bottom line was this: I was trying to just answer the question, what is the actual net derivative exposure of JP Morgan? I did this like in 2009 or 10 because I'm weird that way. They have this annual report that's this thick, and they have every table in there. And I found out that their $300 billion of derivative exposure, notional, which we don't actually know what it means, at the actual value level, but they said, oh, here's how much we think our exposure to that is. And it was literally a paragraph way deep on like page 200 where the bank executives had just decided what it was. They were allowed to use their, I forget what the term was, their expertise to sort of decide. This was one of the biggest items in this whole giant document, and it was a single paragraph, and it basically was the equivalent of this, right?
Yeah,
I don't like
yeah.
not knowing, but I
Well,
couldn't
I
figure
mean,
it out.
this is what's really important about an open market is that you have transparency. You have people who will make a bid and an offer, and they'll have a spread, and you can see, and you can also check their financial credentials as well in terms of as a market making participant. But in the derivatives world, uh, it's as I say, it's over the counter. So you and I could have a derivative contract right now on the price of gold, and
Hmm?
we could link it in with the price of oil. And I could pay you the next 6 months worth of return, and you could pay me after that, and we can make it as complicated as we want. And what's really hard is how do you create transparency in that sort of system? Because it's usually derived from a risk mitigation strategy from a customer that the bank has, an industry that needs to manage exposures, and it's customized, it's bespoke, and then they try to net things off. But we don't have any actual real exchange. We don't have a
Yeah.
set of standards. There are like certain contractual standards for enforcement. There's like international agreements, like I think they're called ISDA agreements, and they help counterparties police the actual relationships. But in terms of understanding the exposure, it's really, really difficult. And what I find quite disconcerting is that these exposures are very much priced and valued by the executive or some sort of unknown mechanism. at the bank and at the institution. And but what's really important is how do you assess that bank's balance sheet and financial health if you can't understand its liabilities and you can't really understand its assets because it might have derivatives on both sides. And so, how do you actually really understand what the net position of the bank is? And a lot of banks actually trade very near to book value, which is interesting. And it's always been a major question in financial circles: is why is a bank that's making so much money trading like it has a huge amount of liabilities? And I think the answer is because of the derivative exposure creates a huge uncertainty and unknown around that bank's future.
Oh, that's fascinating. I mean, that could be so. One of the something I haven't liked about derivatives is it's created the appearance as if we've taken all risk and ejected it into outer space. And to me, derivatives really possibly, and this is just guessing, represent a form of insurance that works perfectly until you need it. But it's like any insurance, right? There's no insurance set of policies in the world that can work if everything goes wrong, right? You know, we insure our houses against disasters, but if the hurricane comes and levels all the houses, the insurance is busted, right? It doesn't work out anymore. So but you know, when I see that like little tiny, so one of the things I was doing in prep for this, looking at all these banks I showed you that were halted, I asked, what's the derivative exposure of these banks, right? And all I can see is their notional values, but these little tiny banks, Stephen, have 10, 50, 100, $200 billion of derivative exposure, you know? And you can't make sense of that because, again, we don't know the nature of the contracts and how complicated they are and how they net out and who they're with. Can't know any of that, but it's just everybody's using them. And you remember, I don't know if I'm old enough to remember that like Orange County, California would routinely get sold some bizarre product that they didn't understand from Wall Street. You know, Morgan Stanley or Merrill Lynch would come up.
The first bank I ever worked for was Bankers Trust, and they were involved in a huge lawsuit against with Orange County with options contracts, I think it was. And it was a massive story in the day because bankers actually invented the options pricing methodology, Black-Scholes, and they made a huge amount of money selling these option contracts to all these states, and they blew up, and it was a huge lawsuit.
Yes, you had a front seat on that, but yeah, it's kind of like
it was well before my time. I think I was maybe 5 years old or 10 years old when it happened.
But the point is, I mean, there are these things that worked great and until they were actually needed, and then they sort of blew up on people. And just to put a little exclamation point on that story, wasn't it Scholes himself who got involved in long-term capital management and smartest guys in the room? And this was LTCM blew up in 1998 because they had these can't lose bets on bonds, and it blew up and they lost. And so even the smartest guys in the room sometimes get burned by this stuff. Scholes himself, I believe. Well, or was it Black?
A lot of the time,
I think it was Scholes.
I mean, I wouldn't be banning derivatives. I just think that the regulators need to probably bring as much transparency to the process as possible and some sort of standardization so that we can understand what those risks are, because the market needs to be able to digest information and price accordingly. But you're right, we just don't know. I mean, like a derivative can be fantastic. If I'm a farmer and I'm about to invest in 100,000 acres of land and I want to buy a weather derivative, so if the rain doesn't fall like I thought it would, it'll pay me money because my farm's not going to produce, and it'll help protect the financial future. It's a form of insurance, and that makes all the sense in the world. But it needs to be transparent for those financial institutions who are making a market so that we can price them accordingly. And as you say, we just don't know. Maybe some people know, but I don't think the regulators know, and I don't think the market knows.
Well, my sense is, and we can close up with this, is that there's a lot of unrealized losses kicking around in the system, and I'll tell you why I think that, particularly for Europe. At one point, the most astonishing chart I ever saw was that there were $19 trillion worth of negative yielding bonds in the system. And I still don't totally have my head wrapped around what a negative yielding bond is, because let's say you're Germany and you want to borrow money from me and you say, hey, you have to pay me for the right for me to borrow money from you. Like I said, I have a hard time with the concept, but let's just back it up. Somebody was the owner of those, proud owner of that $19 trillion, right? A bunch of somebodies. People owned that. They're clearly not worth $19 trillion anymore. I'll just say let's be generous and say there's only been a 5% haircut. Where did that $1 trillion of losses go?
Wow. I mean, like it's again, it's probably not marked to market. It's not. They haven't actually priced them. They're in unrealized. And my understanding is a lot of these hold to maturity in uh, assets that they hold don't actually have to be priced on a real time basis. So they don't actually have to disclose a lot of these losses or realize them. So it's yeah. I mean, to me, again, going back to what we said at the beginning, when you have the authorities setting the interest rates for the marketplace, and they do so for political purposes and not for risk mitigation or understanding of risk. Because remember, an interest rate should reflect the risk in the market. It should reflect the competitive environment. It should reflect the demand of depositors for a return, and all of these other factors. It should not reflect the political appetite for a market sell-off. I mean, that's what they've done. They've politically managed these rates since the 1980s and 90s on an incredible basis. So I would say that the people wearing this risk is the pension holders, and they're seeing it in their pension returns, and we'll see it in those pension returns being reduced drastically. And you also have a lot of these financial institutions who make an awful lot of money off the back of these transactions because they work with the authorities in many respects as well. So an unholy alliance, and I think at the end of the day the pensioner pays.
Yeah, well, we certainly saw that with the UK pension system when the gilt market went upside down. They got caught on margin calls that I think was last I saw was £100 million or something like that in a
Yeah,
1.5 trillion pound system. I mean, big, nasty losses in a system that shouldn't really have any and shouldn't have been forced into that position in the first place. So we can say, oh my gosh, those crazy pension managers, what were they thinking? Going long on duration and levering up and all that. But actually, they shouldn't have had to, right? I'm convinced that
no,
the biggest sin of the central banks is thinking that they deserve to set the price of money. That's the interest cost. The markets should always
yeah,
be setting the price of money,
always.
period. Full stop. You
Yeah,
know?
yeah. I mean, like and if you look at the sovereign bond yields, I think France and Ireland are very closely aligned with Germany. You know, which says that the default risk of France and Ireland is similar to Germany, which is crazy. I mean, like that's nuts. And most of these bonds are being bought by central banks. I mean, so they're setting the yields at the price point. I think a lot of people find the bond market just very, very quizzical and confusing, and it's not based on any fundamentals anymore. It's based on political, trade wins and what's required in terms of the president going out and saying, everything's fine here, move along, everybody. It's no one's going to pay anything, and you won't know who's paying. And
Hmm.
there's no suckers in the room, and off you go. Uh, yeah,
Yeah.
not good.
No, no, and thank you so much for bringing in the China, Iran, Saudi Arabia axis that's going on there because this is a really big deal. Not just geopolitically and how it pretends potentially to various geopolitical events, but from a monetary standpoint. I'm old enough, Stephen, that every single time in my lifetime when some country has attempted to break the petrodollar, it's not gone well for that country. Let me just, oh, that's my own euphemism. Okay, let me just slide that one in.
Yeah,
But China's big enough to be able to get away with it, and for them to have pulled in two of our former deep satellite countries, because most people don't remember this. Iran's been on our demonization list for a long enough. People might have forgotten, but we were good friends with Iran for a long time. We were training their military pilots, and with the Shah, we had like very deep relationships, and it was all good for a long time. Not since the revolution, but um, this is a big deal because China's now brought them into its sphere of influence, and they're no longer in our sphere of influence. And earlier, Deborah left a comment on here saying that she works with the Saudis and that they only do things in their own interest and when it makes sense, right? So it speaks loudly that particular moment. I think people should pay more attention to it.
I actually read that today. That press release, Prince Saud. I actually thought it was really great. It was refreshingly honest. I think it was. General de Gaulle in France said, countries don't have alliances; they only have interests.
Mm.
And it's true. But at least the Saudis actually said it, and it's so refreshing because most Western countries would just talk. Oh, to talk both sides of their mouths, and it's like we care about the people, we want to help those people over there, and it's really they're just looking for energy security or market security or market access, and an alliance of some sort to help them achieve their goals. So it's great to see. You know what, I'm not saying that the U.S. dollar's days are over or the U.S. economy's days are over. I believe in anti-fragility. You ever hear that book, that term?
Yep.
Nassim Taleb had
Yep.
a book called, and what can hurt you and affect you makes you stronger. And I hope that the 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 rest of the world react and improve their systems in a way that actually works for the people. And maybe I'm completely naive in saying that, but if China brings out a new currency and they start taking over the world's economy and setting the rules, I don't think that would necessarily be a good thing. And maybe what it'll make the response will be something from the States and from something from Europe that will be a much better marketplace economy where the world can turn to. So maybe some good will come from this situation. I don't know. I hope.
Yeah. Well, I've been watching the markets long enough, so we will close with this because I know I got to get you off to dinner. But I'm looking here. This is unusual to me to see gold up $50, right?
Yeah.
That's that big green square there. That's an unusual move for gold at 2.7%. There's sort of an informal 2% rule on gold as far as, that's the way I've interpreted it. Like no more, thou shalt not pass more than 2%, right? That's a pretty big move. How do
Yeah.
you interpret that?
It's huge. Yeah. Technically, it's also really good. It's bounced off some interesting technical levels. Um, Again, I would want to wait a few days to see what holds. I would be careful to take any signal on a day's move. News is being digested right now. If it's such that like the next big news headline will be what will the Fed do? Are they going to start
Hmm.
signaling a pause in rate rises and maybe even a cut should circumstances warrant it? They're the type
Yep.
of phrases that will come out, and the market will take signal from that, and gold will take signal from the dollar, which takes signal from the market. So yeah, let's wait a few days to see what comes of it. But right now, we have a lot of motivated buyers coming into the market, and they probably are buying today because they see this as a very very reasonable price to get into. And I would not if somebody does not own precious metals yet and they're worried about the price being up 2.5% today, and they want to hold off a little bit. That's fine. There's a rule that we talk to clients about is try not to time the market because you're buying a tactical asset here, and it's probably more expensive to not have it at all than to have it at the wrong price. And if you're worried about buying it at a high point, then maybe put 30%, a third in today, a third in next month, and a third in the month after that, and average your way in. And if it goes up from here, you're going to look like a superstar that you bought some today low. And if it goes down from here, you look like a superstar that you bought more in the future at a lower price. So don't get caught up in the emotion of the market. Cost average your way in. Look at it as a tactical allocation. It's something that you're buying as a contingent asset. Should the wheels come off the bus, you'll be very glad you had it, and you won't be panicking in a really super down market. And that's really its role, is to kind of calm you down, as every good insurance should.
Well,
And this is
I
not
go
financial
further than that.
advice.
Yes, thank you for that. I also believe in people having a garden and maybe having a little stored food and knowing their neighbors really well and on and on and on. To me, this is a period of time where with these disruptions, the more we can control what we can. I can't control a lot of stuff in the world, but I can gain a little self control over some of the things going on out there. So yeah, very pleased
So
to have you here
what
today.
I love, Chris, what I
What's that?
love about what you do, what I love about what you do, it's actually all about empowerment and education, and not having the answers, but asking the right questions, and understanding about preparation, and not being shy about it. And that's really what it all comes down to in the days, educating yourself. And I think you do an amazing job and have helped so
Well,
many
thank you.
people. It's incredible work.
Well, thank you, thank you. And particularly to people in Europe. I got to be honest, when I just put out a piece on, the UK is just out of veggies right now. Okay, that makes sense. The greenhouses in the Netherlands didn't have enough gas to couldn't afford the gas to grow peppers or whatever. But you can feel like there's just all these different pressures coming on, and there are really easy, relatively easy positive solutions that get you through all of those, right? So even if you said I'm worried about food insecurity, so I'm going to have a garden, that's great. But within about a year, you're going to be out there and the birds and the bees and having dirt on your fingernails, and you're going to go, this has its own benefits all on its own, right?
Mhm.
It's it's a very therapeutic thing to be involved in, in
Yeah.
lots of ways. So I just think there's lots of ways we can be positive about this, but I do believe, Stephen, it's important for people to know what the context is so you can assess what the actual risks are. If you only read the newspapers, what did Mark Twain say? If you don't read the newspapers, you're uninformed. But if you do read the newspapers, you are misinformed, right?
Yeah.
So there's a lot of misinformation out there right now. It's very bad.
It is, yeah. And just on the farming thing, I don't have green fingers. I want to be that person. I have loads of clients who grow an insane amount of vegetables in their garden, and they have like these polytunnels, and they're just very, very productive, and they
Yeah.
give it to all their friends. But I have a client who runs a farm, an organic farm, and my family, we buy all our meats and our chickens and our beef and our lamb from him and his farm. And I drive down there every few weeks, and I fill my freezer, and he does incredible work. His farm is called Featherfield Farm. If anybody's interested in getting into organic farming, you won't find a more informed person. His name is Mark Hurst, and he's absolutely superb. He really cares about it. So shout out to Mark and all his great work he does.
Yeah. So if you can't have a garden, support somebody who does and does it well, because there's a lot
Yeah,
of
be a
really
friend to a
brilliant.
farmer.
Yeah,
Yeah,
and the people who do it well,
support.
it is a really technically demanding and physically demanding job to do. I mean, to
Oh,
do it well is complicated, if not
well, I
complex.
pay more. I
So
pay more for that beef and that chicken and that lamb. But once you try it and once you taste it, you don't go back. It is the most incredible quality food you've ever had,
yeah,
and it's worth paying a little bit more for quality and feeding that to the family.
yeah, I'm glad to hear you say that. I really am, and I hope other people take heed of that because it's important.
But
But
When you come to Ireland, Chris, we'll bring you down
yeah,
there and we'll show you the farm. Can I just say one
when?
thing
Okay, yeah.
on that farming question? When he took over the farm, I think maybe 13 years ago, it was a regular farm, and they used to use normal phosphates and chemicals to kind of increase the yield, and it destroys the all the different variations of plants and stuff. And Mark and his lovely wife Ali, they brought the farm back to an organic level, and over 10 years they did it. They did an audit at the beginning, and I think they had something like, I'm going to say here, maybe like 30 or 40 species of insects per acre of land. And then after running as an organic farm, they had increased that number to like 250 different
Oh,
species of
that's great.
insects were now habitating throughout the farm. Unbelievable, incredible success.
Yeah. Oh, that's fantastic. Because one of the things that does cause me great alarm is the plummeting insect populations around the world. It's just it deserves a lot more attention than it actually gets, and
Yeah,
so I wish we
yeah,
had
yeah.
more people doing what you just described there.
And
All right,
human
well we do have
fertility.
to.
Sorry, the whole human fertility
Oh yeah, this
is
is
a
very.
huge issue right now too.
Yeah, no, it's very much not good. And this is it's taken a sudden drop of late too for other reasons that it's difficult to go into here on YouTube. But male sperm counts have declined 50% over the past 40 years,
Yeah,
and it's global. So it clearly speaks to an environmental something or other. And if we were an intelligent species, we would say, what have we been releasing into the environment that's new in the last 30, 40 years? And let's start taking it out, you know?
yeah.
But we're not doing that.
I
So,
have no idea. I'm like, I have no idea what's going on, to be honest, in that regard. But it is scary.
yeah. Yeah. So, Ryan, just bring this up one last time. So, yeah, anybody who wants to, you're thinking, just give the people at GoldCore a call, and you'll be really surprised because the thing they excel at is customer service. And as Stephen very importantly mentioned, nobody's um, uh, compensated by the sale itself. It's that they are compensated to be help you and be great at customer service. So check that out. If you go through peak.fan/GoldCore, they'll treat you well. Tell them you heard about it here, and you'll be treated double well, which is hard to do from a
Absolutely,
4.9.
100%. Thank you so much, Chris. I really appreciate being on the show today.
Yeah, we'll do it again as events develop, because I have a sense that we'll have a lot of opportunities to talk over the coming time. So thanks again, and thank you so much for being available, Stephen. Really appreciate it.
No problem. Thank you so much.
Thanks.
See you, everybody.
Yep. All right, bye everyone. We're gonna call it here, and we'll be back with you next time. And there's lots of things breaking, so as things start to develop in the markets and elsewhere, I'm just going to be firing up these live chats. I started this one just sort of about an hour ago. Before it started, we decided to do this. So that's going to happen a lot. So just keep your notifications on, and we will be parsing things as they come up. Thank you so much for being here. Loved all of your comments in your chats there. And if you have anything you want me to know, leave it down in the comments after this is the live part's over, because the chatters get to participate in the live chat. But if you're watching it afterwards, leave a comment down there with me in the comment section, and I'll see it. All right. Thanks very much, everybody. We will see you next time. Bye-bye.